Hi, the retirement spending trap. Here's something most retirees never see coming. It's not the stock market, it's not inflation, it's not even healthcare costs. It's the fact that many retirees, especially those who saved well, spend much of their retirement living more cautiously than they need to. Not because they can't afford their lifestyle, but because they're afraid to use the money they've worked decades to build. They delay travel, they skip the upgrades, they say no to experiences with family and friends, even though their plan could support it. And here's the kicker. At the end of their life, they can often leave behind more money than they intended, but with fewer memories than they wanted. That's what I call the retirement spending trap. And the reason it happens is simple. Most financial plans are designed to protect wealth, but not necessarily to help you enjoy it. In this video, I'll walk you through the 5 mindset traps, market fears, and outdated strategies that cause people to underspend in retirement and what you can do to avoid falling into the same pattern. Hi, I'm Hank Persia, President and owner of Starboard Wealth Advisors. We help high net worth retirees and pre-retirees build smart, tax-efficient retirement income plans so they can spend with clarity, protect their lifestyle, and live with purpose. If that's the kind of clarity you're looking for, you'll find straightforward guidance here without the hype or confusion. Now, let's take a closer look at the 5 retirement spending traps and how to make sure you're not living beneath your plan. Trap number 1. You've been trained to accumulate, not distribute. Let's start with the biggest mindset change that trips up many retirees. For 30 to 40 years, you've been told to save, invest, and defer gratification. You've contributed to your 401k, reinvested your dividends, and skipped luxuries in the names of saving for retirement. But when retirement arrives, something strange happens. The same discipline that helped you build wealth starts holding you back from enjoying it. You've spent decades in accumulation mode, but retirement requires a new skill, distribution, or the ability to use what you've saved intentionally and sustainably. This doesn't come naturally. I've seen retirees with $2 million in assets who feel guilty spending $5,000 on a vacation. Not because they can't afford it, but because they're wired to feel like they're breaking the rules by dipping into their accounts. This is where a structured income plan can make a difference. When you know where your income is coming from each month and that your spending is built into the plan, you give yourself permission to enjoy what you've earned. Trap number 2. You're letting market fear freeze your lifestyle. The second trap shows up when markets get rocky. You see a dip in your portfolio and suddenly you start second-guessing every purchase. Should we cancel the trip? Should we wait on that house renovation? Should we just stay put this year? This is understandable but dangerous because retirement isn't a straight line. The early years are often your most active, healthiest, and most mobile phase. If you let market headlines dictate your lifestyle, you may end up pausing the best years of your retirement waiting for some kind of perfect time to resume. Here's a better approach. We help clients build income buffers, like keeping 12 to 24 months of spending needs in cash or short-term investments. That way, when markets are down, they're not forced to sell stock or cut spending. This kind of planning removes the pressure to react emotionally, because your day-to-day lifestyle shouldn't depend on what the S&P 500 index did last week. Trap number 3. You're avoiding principal when it's the right tool. This trap is one of the most common and one of the least necessary. A lot of retirees say things like, we're trying to just live off the interest, or we don't want to touch the principal. Now, there's nothing wrong with being conservative, but here's the truth. Your principal is part of the plan. It's not off limits, it's part of what you saved for. Let's say you saved $1.5 million and your plan says you can withdraw $70,000 to $80,000 per year with high confidence that your money will last. Whether that income comes from interest, dividends, or a modest drawdown of principal, the plan accounts for it. Trying to live only off the income can lead to one of 2 outcomes. You spend far less than you could have enjoyed, or you take unnecessary investment risk trying to chase higher yields or interest rates. Instead, we help clients focus on total return, a combination of income and growth. Then we build a withdrawal plan that gives them the income they need in a tax-efficient and sustainable way. The goal isn't to preserve every dollar at the expense of your lifestyle. The goal is to live well without outliving your money. Trap 4. You're treating every year like it's the same. Here's a key insight. Retirement spending is not flat. It comes in phases. We call them the go-go years. Right after you retire, life is full of travel, hobbies, grandkids, and new experiences. The slow-go years, ages 70s to early 80s when travel slows and routines become simpler, and the no-go years, ages 80s and 90s when spending shifts more towards healthcare and support. But many retirement plans assume a straight line withdrawal, same spending every year adjusted only for inflation. The problem? That often leads people to underspend in their most active years out of fear that they'll need the same amount later. In reality, most retirees spend more in the first 10 to 15 years, then naturally reduce their expenses as their energy level and lifestyle needs change. That's why we model dynamic spending into retirement plans. You may need $100,000 in your early 60s and $75,000 in your 80s. And that's not only normal, it's strategic. By planning for these phases, you avoid over-restricting yourself during the years that matter the most. Trap 5. You're not revisiting the plan often enough. Finally, one of the most preventable traps is failing to adjust. You built a retirement plan, say, 5 years ago. Markets have changed, tax rules have changed, your spending has probably changed too, but you haven't updated anything. This kind of set it and forget it approach leads to missed opportunities. You might be taking more investment risk than you need, you may be overpaying in taxes, or you might actually have more flexibility to enjoy life, but you don't realize it. We recommend revisiting your retirement plan at least once a year. For our clients, we review spending patterns, portfolio sustainability, tax opportunities like Roth conversions or capital gains harvesting, and gifting potential to family and charities. Sometimes clients walk in thinking they need to tighten the belt, and they walk out realizing they can actually afford to do more. Without regular reviews, you risk living more cautiously than necessary. With a clear check-in process, you stay confident and proactive. So let's recap. The retirement spending trap isn't about spending too much, it's about spending too little, out of fear, habit, or uncertainty, and that can rob you of the retirement you've worked so hard to build. The good news, with a thoughtful plan, you can avoid these traps and give yourself permission to live fully, confidently, and on your terms. If you're approaching or already in retirement and want to make sure your plan is giving you not just protection, but freedom, let's talk. Click the link in the description to book a complimentary consultation. I'll walk you through your income strategy and help make sure your money is working for you and not holding you back. Remember, at Starboard Wealth Advisors, your financial destination is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no fluff retirement guidance, or contact us for a simple phone or Zoom call.